Good morning, good afternoon, and good evening. Thank you for attending today's webinar, Developing and Selecting CAPM Betas, a new module in the Cost of Capital Navigator. I'm Zach Rodheim and will be your host today. As the leading independent provider of risk and financial advisory solutions, Kroll leverages our unique insights, data, and technology to help clients stay ahead of complex demands. Kroll's team of more than 6,500 professionals worldwide, continuing the firm's nearly 100-year history of trusted expertise spanning risk, governance, transactions, and valuation. Duff & Phelps acquired Kroll in 2018, and we began transitioning our firm to Kroll brand in 2021. Before we begin, I want to cover a few housekeeping items. On your screen are multiple application widgets you can use. All the widgets are resizable and movable, so feel free to move them around to get the most out of your desktop space. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner. We encourage you to submit questions during the presentation using the Q&A widget on the bottom of your console. If we don't have a chance to answer all of your questions, we will respond to you directly via email. A recording of today's webinar will be posted to Kroll's website and distributed to all attendees in due course. Likewise, you can download today's slides from the related content box in this platform. Finally, today's webinar is eligible for 1 CPE credit. You can download the certificate at the end of the presentation by accessing the certificate widget on the left-hand side of your console. You will need to answer all 4 polling questions to receive full credit. As a gentle reminder, this presentation is made available by Kroll for educational purposes only. And now I'd like to introduce you to our 3 speakers for today. Carla Nunes is a managing director in the Office of Professional Practice, based in our Philadelphia office, and is a Kroll Institute Fellow. She is also the global leader of our Valuation Digital Solutions Group, which produces cost of capital thought leadership content and data housed in the Cost of Capital Navigator. She has over 25 years of experience. In her OPP role, she provides a firm-wide technical guidance on a variety of valuation, financial reporting, and tax issues to global project teams. Our second speaker today is Kevin Madden. Kevin is a director in the Valuation Digital Solutions Group based in the Chicago office. Kevin has more than 10 years of experience in financial services, specializing in project and product management and financial analysis. He is a lead contributor to the content and data housed in the Cost of Capital Navigator platform. And our third speaker today is Aaron Russo. Aaron is a vice president in the Valuation Digital Solutions Group. He specializes in data management, automation, and product development management for the content and data housed in the Cost of Capital Navigator platform. Thank you all for your participation, and I will now pass it over to our first speaker, Carla Nunes. Carla, please take it away.
Thanks, Zach, and thanks everyone for joining us today. We hope you find it useful. Our agenda here today starts with the beta estimation basics, and that's just for us to refresh ourselves that we're talking about the same nomenclature, and we know when we're selecting a beta exactly what we're implying by its selection. We also will give you an overview of different beta types, beta best practices. We will then talk about some of the resources you have to get levered betas. What are some of those, and compare them and contrast them. We'll talk a little bit about adjusting for financial risk, so unlevering and relevering formulas. And we will have a case study to walk through all the concepts that we outlined first, like 1 through 5 in your agenda. We will, at the end, show a very brief demo of our Navigator platform just to see some of the line items and case study elements that we walked through earlier. Before we start the session, though, we're going to have our first polling question. And this one is really easy. Which geography are you located in? So United States, Canada, Latin America, EMEA, so Europe, Middle East, and Africa, and Asia. I'm sorry, it should say Asia Pacific, not Asia Pacific, and other. So if you could fill in the first polling question, that would be great. I'm getting there, just a few more seconds. Make sure that if you want your CP credit to respond. Okay, I think we're going to push the results now, and let's see. We have 73%, 74% almost from the U.S. We have a good coverage from Canada and EMEA, and understandably so, Asia Pacific. I'm happy that someone could actually do it with the time lag. Anyway, so for now, we're going to get started with the content. Aaron, do you want to go next?
Sure. So start off with talking about beta estimation basics and a quick review. What is beta? So beta is a measure of systematic or market risk of a stock, which measures the tendency of a stock's price to correlate with changes in a specific market index. It's important to note that beta does not measure unsystematic risk or company-specific risk. And in CAPM, beta is the measure of risk, and we can see the beta within the context of the CAPM equation below. So industry risk premia, for people who like to use buildup, it's important to note that the buildup method also incorporates beta, and it's reflected in the industry risk premium, which is calculated as beta times ERP minus the ERP. So when we're calculating beta, there's a lot of things to consider, and we'll talk about kind of the 5 most important ones that we consider that really are worth your attention. And so these include the choice of the market benchmark, the amount of return history used, 1 year, 3 years, 5 years, the beta stability over time, the return frequency used for the returns, and the statistical quality of the betas. So for the market benchmark, this is important because this is what you're going to be measuring your individual stock prices against. And in the U.S., the S&P 500 is typically chosen as the market benchmark. For global betas, we see the MSCI World Index often used, and more recently the MSCI All Country World Index, the ACWI Index, is considered an even better proxy for a global benchmark. I don't know why these slides are moving so fast. Sorry about that. And it's important to note that with highly correlated benchmarks, the betas are going to come out very similar. So in this chart on the left, you can see Apple's beta calculated against 3 different indices, the S&P 500, the Wilshire Index, and the CRSP Large Cap Index. And over time, we can see that these betas are extremely highly correlated. But it's important to note that this is not the case if you're using an undiversified index or an index with very few constituents. So the next consideration is the beta frequency, the return frequency, and the amount of history. And we'll talk about this more in depth later on. But quick notes are that there's different ways to choose to calculate the return. So you can use just price returns, you can use total returns, or you can use excess returns. And then there's different choices for the frequency. So intraday, mostly just for traders, and then daily, weekly, monthly, annual. And for valuation purposes, the most common that you'd see is a 5-year monthly, which is 60 months or 60 observations in the regression. But commonly, you'll see 2 or 3 years of weekly returns used as well. So another consideration is the beta stability over time. Sometimes you'll see a fundamental shift in a company's beta, whether it's due to strategies or market fluctuations, things like that. And so in this instance, this is a real bank's beta, and we can see that there's a fundamental shift in this company's beta pre and post the 2008 crisis. And so it's important to ask yourself whether or not, in this example, whether or not the pre-2008 beta is representative of this company's risk going forward. Another consideration is the beta statistical quality, and there's various ways to measure this. One of which is the R-squared, which is commonly referred to as the goodness of fit. R-squares on beta regressions typically, something good would be considered around 20 to 30%. This may seem low, but this just indicates that there's other factors that are explaining the realized returns on a security. So if you're seeing 20 to 30%, it's nothing to be alarmed about, but if it's approaching zero, then there may be some statistical quality issues with your beta. The next measure is the standard error of the beta estimate, which measures the likelihood that the true beta is captured by the estimate of the beta derived through the regression. Sorry, these slides are just jumping ahead of me. And so on the left, you can see two companies, one with a beta with a low standard error and one with a high standard error. And you can see how volatile the red line is with the company with the high standard error. And so with betas with high standard error, you may want to consider throwing them out. Another statistical quality measure is the T-stat, which indicates whether or not a beta is statistically significant from zero. Sorry, I don't know why these are just jumping. And so the T-stat is usually measured against a critical value. And in the case of betas, we typically look at a value of 2. So if the T-stat is above 2, we can say it's probably statistically significant from zero. Otherwise, we may want to consider throwing it out. And then we also could talk about top-down and bottom-up beta estimation. So top-down is basically a historical OLS or sum beta for an individual company. But the problem with these is that they can often be too noisy from a statistical standpoint. And so another approach is a bottom-up beta. And I should mention with the top-down beta, when you're doing, just a historical beta calculation, that's what you're going to get. But we also talked about bottom-up betas or proxy betas, which requires identifying the businesses that the subject company operates in, and then identifying guideline public companies and estimating their levered betas, which can be used as a proxy. And this can be good for, a division or reporting unit or a closely held business. And then levered versus unlevered betas. So levered betas, that's what you're going to get when you calculate a historical beta. It's going to be inherently a levered beta. And this incorporates two risk factors, the business operating risk and the financial risk, or the capital structure risk. And levered betas are sometimes referred to as equity betas. And then the unlevered betas, which control for or remove the effect of the company's financing decisions. So this is a beta that would be expected if the company were financed 100% with equity capital. And these are oftentimes referred to as asset betas. So now we can talk about some different beta types. So the most common that we hear about is the OLS beta. This is the ordinary least squares beta, and Bloomberg calls this the raw beta, and you'll sometimes hear it referred to in that way. But an OLS beta is just the typical linear regression beta. So if you were to map a company's excess returns versus the market excess returns and estimate a best fit line, the slope of that best fit line is the OLS beta. And then we have a sum beta, which we'll commonly see used for smaller companies or companies that are thinly traded. And what the sum beta does is it tries to account for the lag that we'll see in a market's reaction in some of these smaller or thinly traded companies. And so what a sum beta does is it sums up the beta coefficients of two regressions in a multiple regression. The first is a typical OLS, which is the stock's current month excess returns over the market's current month excess returns or current period excess returns. And then the same thing, but the stock's current month over the market's previous month or previous period. And so that's where the lag is kind of incorporated. And what we'll see is that sometimes, a lot of times actually, some betas have been shown to be better predictors of smaller companies or thinly traded companies' excess returns within the context of CAPM. And one important note with OLS versus sum betas and the cost of capital navigator, particularly with the size premia. So the cost of capital navigator provides a few different studies for size premia, and size premia are measured using a beta estimate. And so it's important to know what type of beta is embedded in these size premia. So with the CRISP decile size study, This employs OLS betas to calculate the size premium, and then the risk premium report study and the European size study use sum betas in all calculations. So when we talk about cost of capital and beta, these are forward-looking measures, right? So what we're really trying to do is predict the future in a sense with these estimates. And so with the beta, what we really want is a future beta. And so what can be problematic is that using historical betas like an OLS or a sum beta, these are only going to be representative of the future insofar as much as the past repeats itself. And so oftentimes we'll consider adjusting our betas to be more forward-looking. And there's a few approaches to do this, like the Bloom adjustment, which adjusts towards the market beta, the Vasicek adjustment, which adjusts towards the industry beta, and the portfolio or peer group beta, which adjusts towards the peers or the industry. And a quick note on Bloomberg's adjusted beta. So when you're looking for betas in the Bloomberg terminal, for example, you get two options: the raw beta, which is just the historical OLS beta, and then an adjusted beta. And this adjusted beta is a 1/3, 2/3 adjustment. So it takes 1/3 of the market beta, which is 1, plus 2/3 of the historical beta that was calculated. And this results in the adjusted beta. And we point this out because this adjustment is based on the Bloom adjustment, which Carla is going to talk about in the next slide.
Okay. I mean, for those of you who have read the paper, the original paper, you'll see that what Bloom said was that, okay, I'm using data from 1920s through 1960s, and I'm using a 7-year monthly beta. And based on various periods during those decades, I saw, this is Bloom saying, Marshall Bloom, I saw a certain propensity to move towards the beta of the market, which is 1, but at various ratios. So this sort of 2/3, 1/3 is a simplification of what the average of those decades, of those coefficients that he saw. So the actual adjustment, if you read the paper, which we cite over there, is 0.371 towards the beta of 1, and then 0.635 towards the historical beta of your subject company. And the one thing to note is that, again, this was over a period of time. They actually moved quite a bit during those decades. So he actually said in his paper that these coefficients could change over time, right? Like, remember, like the world economy today and financial markets are very different from what they were in the 60s, in the 50s, and the 40s, right? So it is possible that the coefficients today would be very different if the analysis was updated. And he also cautioned that the use of an historical regression to correct for a future ratio will not perfectly adjust betas and could undercorrect or overcorrect, and it could introduce even larger errors than just using the unadjusted beta. So for those of you who actually do litigation, this is a word of caution. If you may end up in a litigation, you should be aware of these limitations, because if I was the expert on the other side, I would ask you about it. And in fact, in one of the U.S. Delaware Court of Chancery case, the Bloom adjustment was actually rejected. That doesn't mean it's going to be rejected in the future, but you need to be able to explain, if you're using it, those limitations. So with that, Aaron?
Thanks, Carla. Another adjustment that we like to talk about is the Vasicek adjustment, which is also known as the Vasicek shrinkage or the Vasicek smoothing technique. And unlike the Bloom, this is not a one-size-fits-all adjustment. And so remember when we were talking about the standard error of betas, and if the company beta has a high standard error, you may want to consider throwing it out. What the Vasicek adjustment does is it adjusts a raw or OLS beta towards a peer or industry beta based on the statistical quality of the raw beta. So betas with high standard error, i.e. low statistical quality, will have a larger adjustment towards the peer, whereas companies with high statistical quality and low standard error will have a smaller adjustment towards the peer beta. And then lastly, we have the portfolio beta. And this is the weighted average of the betas of securities in a portfolio using typically market cap weights. So this is kind of like a bottom-up beta. And the portfolio beta is the measure of an entire portfolio's sensitivity to overall market changes rather than an individual company sensitivity to the market. And so this can kind of help smooth out the issue of the standard error that we were talking about. And portfolio betas are calculated in the company level beta module as the market cap weighted average of the OLS betas of the comparable companies that the user selects. I'll pass it off back to Carla to talk about beta best practices.
Thanks, Aaron. All right, so let's go through some of the best practices when you're doing betas. The first one is OLS, so the historical betas. OLS meaning the OLS regression, right? So it's best for you to use betas that are statistically significant. And as Aaron said before, a shortcut is to look at t-stats that are greater than 2. Obviously, it depends on your level of significance and the number of observations. But so it could be even lower, the critical t-stat, depending on number of observations, but at least like a shortcut for significance. You want to be careful, though, if there was a significant transaction in the company's history over the period that you're looking back for the historical beta regression. The reason being that if there was a major acquisition or divestiture, the underlying business risk might have changed significantly. And so an historical beta of the company that survived, because often when there's like big mergers, for example, one company survives that's still being traded, it may be different going forward. A way to look at that to see if there's something fundamental changing is looking at trailing betas over time to look at stability. And we'll show you an example in the case study how you can look at that. For some betas, preferably you only use it for small or thinly traded companies, because for really large companies, if you think about it, what some betas try to do, especially if you use monthly betas, is to say, well, not all of the information has been reflected in the market. Turns out, of course, if you're looking at large companies or even like mid-sized companies from a market cap standpoint, all of that information has been reflected contemporaneously. And if you're looking at the relationship for what happened a month ago, you may actually have distorted betas. So some betas are pretty good for very small companies, or if you're just looking at large portfolios of stock. But when you only have like a peer group of, say, 5 or 6 companies, be careful when selecting whether or not to use some betas. And then VASI-check, honestly, that's my favorite because it can be used in any project. And if there are peer group companies that have betas that are poor in terms of like their standard errors are high, this will diminish the weight of those companies that have high standard errors. So it's a very good forward-looking adjustment. In some cases, doesn't make that much of a difference, but in some it can make a difference. So let's stop a little bit to think about the market index. Okay, and the reason is because a lot of times people just take it for granted that it's whatever like data providers provide as a default. That's the way to go. And if you're looking at not just U.S. Comparable companies, remember it's not just about your subject company where it's located, but the group of comparable companies that you're dealing with. What is the best practice for the market index? And I'm going to read you 3 quotes. This is the first one from McKinsey. You know, the Bible in valuation, right? The textbook. So here's what they say. So most well-diversified indexes, such as the S&P 500 and MSCI World Index, are highly correlated. The 2 indexes have a 97% correlation between 2000 and 2018. Thus, the choice of index will only have a small effect on beta. I mean, that's if you're using well-diversified indexes, right? This is my stop. I'm going to read the rest. Do not, however, use a local market index, which some data services provide. Most countries are heavily weighted in only a few industries, and in some cases, a few companies. Consequently, when measuring beta versus a local index, you are not measuring market-wide systematic risk, but often a company's sensitivity to a particular set of industries. All right. And then second quote is, we recommend using a local CAPM for investors and companies facing restrictions to investing abroad. So if you are like in Tunisia, for example, or some other market, like typically more like frontier markets, but it could be emerging markets, and you can't access capital markets outside, and you're doing a beta calculation for a local company that is not going to invest outside, then you would use the local CAPM. Nevertheless, this is quote 3, we don't recommend the local CAPM approach for integrated markets. With a local CAPM, you cannot make a straightforward estimate of a company's beta based on the average of the estimated betas for a sample of industry peers. The reason is that if the peers are in different countries, their local betas are not directly comparable. Okay, so what do you do with this information? So first of all, if you just looked at CAPM and its theory, so finance theory, corporate finance theory, the market portfolio in CAPM suggests that you would include all possible assets that an investor could invest in. So in theory, that it would include things like real estate and artwork and human capital, etc. But in practice, that cannot be done because it's not priced, right? And so the way that we have evolved as a finance industry is to say that the market portfolio, because it's unobservable, it's going to be replaced by a broad-based stock market index. But it has to be comprised of a diversified portfolio of common stocks. So it can't just be focused on one industry or 2 or 3 companies. Otherwise, it's not diversified, right? So what do I do in practice then? If you are dealing with a fully integrated market, then you want to use a diversified, could be regional or a global index. So for example, if you're doing Europe and all the companies are, your comparable companies are all in Europe, then you could use a, MSCI Europe, or you could use a stocks Europe 600, something that is diversified and it's for that region, or you could use a global index. So obviously the US is a fully integrated market. If you have a completely segmented market, so if you can't, let's say that you're in North Korea, you probably cannot invest elsewhere, right? But you want to use a diversified local index, and that's the rub. It's really difficult for some of those markets, if they do have a stock exchange, to actually have a diversified local index. So if you have a mix, like if you're thinking about an India or a Brazil or whatnot, you want to consider looking at both. Do a sensitivity, both a global index and a diversified local index, just to see how different the betas are. Our company level beta module, we actually decided, in order to avoid those problems, to just use MSCI for all of the index that we provide for beta calculations. So that way there's no inconsistency between what the methodology is by the index providers. Plus, MSCI only creates country indexes that are formed by companies that have enough liquidity to be invested by global investors. So if there's not enough liquidity in a stock and it's illiquid, only limited to some domestic investors, those companies would not be included in their index formation. So because of that, we also, some indices only have 2 or 3 companies that are actually liquid enough. For our purposes, what we said was you need to have at least 25 constituents, 25 companies, in order for you to be included as an index, a country index in our module. The only exception was Mexico and Italy, because they each had 23, but they seemed diversified enough from an industry and companies in general. And we do provide you with an academic reference for the dangers of just using an undiversified index for your betas, because it really distorts the concluded betas. The other thing to be aware of is that you might have selected companies as your comparable companies that have trading in different markets and in different currencies. When you're calculating a beta, the currency of the comparable companies should match the currency of the market index. Otherwise, you're going to have a distortion, and we'll show you an example of that later. With regards to return frequency and look-back period, as Aaron said, typically 5 years, 60 months. Actually, that came from an academic paper. The paper said that, when they're looking at what's the best going forward, the estimate of the beta, what did best? And they found that somewhere between 4 and 6 years of monthly betas were the ones that performed the best. And that sort of got ingrained into our practitioners' mind that we tend to use 5 years. But if something dramatic happens in a company's life that I said before, you may want to look at a shorter period. Just make sure that you have enough data points. So for example, if you're doing weekly betas, I would not use less than 2 years as an example. You definitely don't want to use less than 30 monthly observations, because then it starts to be not statistically significant. And then I would be very careful with companies that went through an IPO within the last year, because IPOs are notorious for extreme volatility in the year after a company goes IPO, and the betas may be completely off from what you would expect the forward-looking beta to be. Remember, we're trying to come up with what the future risk is going to be, and that would not be a good proxy in most cases. Just leave you with a couple more. I'm just going to highlight a couple of things on capital structure, and one being that if you know, in periods of a lot of volatility, which we did like have with COVID, where the market cap got really depressed compared to the book value of equity, for example, that, you know, the typical way of unlevering betas, the Hamada formula, might not work so well in those cases. You may want to consider Harris Pringle during those times, and we'll show you an example how to do that. And then the capital structure, also be careful, because a lot of times we use debt book value instead of the market value. And in times where there's a big difference between, you know, when the interest rates, when the debt was issued versus when it actually current markets or interest rates have gone up, that could be a big difference between book and market. And also, you know, times of volatility that can also be distorted. So sometimes you want to look at long-term averages instead of point-in-time capital structure to overcome that. So now we're going to go to our second polling question. And this is asking, which beta sources do you typically use? And this is a select all that apply. So it's a multiple selection question. So do you use Capital IQ betas off the shelf that it's already calculated for you? Do you use Capital IQ betas that you decide which frequency to use, etc., and index to use? Do you use Bloomberg? That's option C. Or do you use like a free service like Yahoo Finance? That's D. Option E is I compute my own historical betas. Option F is another source, and G is not applicable. So if you could select for the next 30 seconds or so, which beta sources do you typically use in your engagements or in your internal analysis? And we have about 75% of attendees responding. Give it just a couple more seconds. Okay. And I'm going to push the results. I'd be curious to know myself. All right. Okay. So teams like over a third use off-the-shelf Cap IQ. 26% use the custom Cap IQ. There's almost 20% using Bloomberg, 16% Yahoo Finance, 15% compute OLS betas, and then there's like other sources. So a good distribution. So with this, I'm actually going to pass it over to Kevin, who is going to tell us about some of these available resources and advantages and disadvantages.
Okay, thanks, Carla. Okay, now we're going to talk about the three resources to get levered company level betas. First, I'll give a quick intro on the new Kroll company level beta module. Then I'll walk through two other resources, S&P Capital IQ and Bloomberg. So the new company level beta module is accessible through our Cost of Capital Navigator platform, and includes over 35,000 companies located in over 100 countries. We provide a company lookup tool where you can search by company name, industry, size, and other metrics. We're using the MSCI universe as a source of market indices, and we're providing over 30 indices that, again, have been screened to exclude indices that have a high concentration in one industry or low constituent count. We provide over 100 currencies, and betas are computed consistently with the same currency at the company level and index level. We offer monthly and weekly returns with 5 different look-back periods. So for example, a 5-year monthly beta is based on 60 returns or observations. The 5 beta types Aaron discussed earlier are available in the new module. In addition, we provide a summary of the statistical qualitative betas, including R squared and T-stat, and you can download all the data and your results into Excel. Okay, so I'll give you a little preview of features and data additions on our roadmap. Soon you'll be able to save your scenarios or estimates. We'll provide you the option to include or exclude operating leases from debt, the option to include or exclude cash from debt. And right now, the module uses the Hamada method for unlevering and relevering. We have plans to introduce the Harris-Pringle method to the module. We're introducing a company tear sheet view with some additional metrics that includes percentage of sales by business unit and geographic location. We'll soon have a feature to see betas over time. And finally, we're planning to add this data set to our Navigator Excel add-in. Okay, on to the next resource, Capital IQ, accessible through their platform or downloadable Excel plugin. Cap IQ has 3 off-the-shelf OLS betas, 1-year 52-week, 2-year 104-week, and a 5-year 60-month beta. The benchmark for these off-the-shelf betas are the S&P 500 for US stocks, TSX Composite for Canadian stocks, MSCI EAFE for global companies in those developed markets, and all remaining global companies use MSCI Emerging Markets Index. The other Cap IQ function they offer is the custom beta when using their Excel plugin. It's very flexible where you can change the market benchmark, look back period, monthly or weekly returns, and currency. Okay, a few things to call out on these betas and functions. The first is with the 3 off-the-shelf betas. If your comp set includes US and global companies, the betas will be calculated using different indices. Second, you'll run into a currency issue when using global companies. The company level returns will be denominated in their local currency, and the market index will be denominated in USD. So, for example, if I were to pull the 5-year off-the-shelf beta for Toyota, the company level returns will be denominated in Japanese yen, and the market index, MSCI EAFE, will be denominated in USD. Next, I want to call out that Cap IQ defines the number of observations based on price, not return. You may run into a number of observations issue using both off-the-shelf betas or when using the custom beta function, again, depending on how you set up your look-back period. So for example, Cap IQ may pull in 60 prices and regress against 59 returns.
And Kevin, just a little note on that. It's, if you look at any finance textbook, you can look it up. What they talk about is 60 months of returns, not 60 months of prices. When you say that you have a 5-year beta, it's 5-year. If it's monthly, there'll be like 60 months of returns, not 59. So just to, sometimes it makes a difference, sometimes it doesn't, but just to call that out.
Right. Okay, and then finally, you may run into a currency issue when using the custom beta function. When you change the currency in the formula, you'll need to look up and change the market CIQ identifier to make sure it's denominated in the same currency you've selected. Okay, on to Bloomberg. Accessible through the Bloomberg terminal or Bloomberg Anywhere. Bloomberg offers 2 beta types, OLS and the simplified Bloom adjusted beta. The beta function on the terminal is very flexible. You can select daily, weekly, and monthly returns, different look-back periods, different currencies, different market indices. And just like Cap IQ, you may run into currency or number of observation issues. Here's an example of the number of observations issue. I've logged into the terminal, defaulted to today's date, and when I select the 5-year look back option, we're only picking up 59 returns. Again, I can make this adjustment. I'm here, I've captured now 60 returns. While we see the change is not material, it can be at times. Just note, it can be at times. Okay, from a currency issue standpoint, just be mindful of the default settings in Bloomberg from using US versus global securities and what the default market index is. So here's an example of how currency can affect your results. We're observing Samsung OLS beta denominated in Korean won. When we change both the company and the index level to USD, we do observe there is a material difference between the two. So there are a lot of great resources and powerful data sets for practitioners. The takeaways are it's important to know what they are, what's included in each, and be mindful of beta best practices and the nuances of each resource. In summary, again, there's advantages and disadvantages for the resources we just covered. Starting with the company level beta module, we built this data set and tool using the framework of beta best practices. We're computing betas consistently in the same currency. We've done the pre-selection and screening for market indices. We provide the statistical quality betas and more. Since this is a new data set, we still need to gain recognition in the market and with our various stakeholders. Cap IQ and Bloomberg are both well recognized in the market and powerful data sets. As we've seen in this presentation, it's easy to run into currency or number of observation issues when using these resources. And as a final reminder, all resources include the OLS beta. Bloomberg does provide that simplified version of the Bloom adjusted beta, and the company level beta module includes all 5 beta types we've discussed here today. And Carl, I think we're on to our next polling question.
Yes, we are. So let's see. So the next polling question is, if you're using OLS, so historical betas, do you typically apply any additional forward-looking adjustments? So for example, the Bloom adjusted, which is the Bloomberg, 2/3, 1/3, fuzzy check, very easy, yes or no, or other, not applicable. And this is our third polling question, so 3rd out of 4. In order to obtain CP credits. And we have, let's just get us to 80% of our attendees at least to respond. All right, I am going to push the results now. And it seems that the majority does not apply any further adjustments to historical betas if they are computing them. Okay, so very, very briefly about financial risk and levering and relevering. So most people use what is called Hamada. That even if you don't know that's what you're using, it's after the academic who came up with this, leverage or formula, or removing the impact of financial decisions from your subject companies and capturing just the business risk. Just be careful for those who use U.S. companies, the interest expense limitation could creep in for some companies to make the interest deduction not really fully deductible in the current time because it's 30% of EBIT currently. And with losses and whatnot, you may need to adjust your tax rate to be less than the statutory tax rate. But besides that, just wanted to briefly talk about Miles Ezel and Harris Pringle. So Hamada is the one that most people use and assumes that the amount of debt is fixed in a capital structure. So what does that mean? Imagine Apple, which is like $1 trillion, right? When they first started, and if they borrowed, let me say that they borrowed $10 million of debt. What Hamada says is that now that you're $1 trillion company, you still have the same amount of $10 million fixed of debt in that capital structure. And that obviously doesn't make any sense from a practical standpoint, right? We know that the typical debt ratio of a company will grow with the company as well as a percentage of the value of the company, not as a fixed amount. And so that's a limitation. The second limitation is that it assumes that you can deduct your interest expense 100%. There's no risk to that deductibility ability, which we know in times of recessions and a highly levered, you are not able to always get the full tax deduction. And so it's a very simplified, easy to apply, but when you have industries that have a lot of debt in their capital structure, that may, or you have periods of volatility, that may not work. The second formula is a little bit more convoluted. It just says that, well, your first year, you get the full deductibility, but after that, the deductibility depends on the risk of your overall operating cash flows. But honestly, you can get the same results with Harris Pringle with not much of a difference in terms of results. And Harris Pringle just say, yeah, I mean, number one, your debt capital will grow in absolute terms, so it will keep as a constant percentage of equity capital. But also your deductibility of interest expense has the same risk as the overall operating cash flows of the firm. What does this mean? So if we look at U.S. debt betas by credit grade, so investment grade is on dark blue, and non-investment grade is in pink. And what we see is that during times of crisis, there's a spike, and debt betas are not equal to zero, and especially not for below investment grade companies. It means that the risk of debt is actually greater. It has its own beta. It's greater than zero. So something for you to keep in mind. So some practical issues here. The beta of a portfolio is always the market value weighted average of the betas that are in that portfolio. And I'm just going to give you a couple more recommendations. So try to use betas from consistent sources. So if you have to be careful, if you use different sources, you're going to get different results just because they have different methodologies. And also you want to make sure that it's, the same index for the most part. We'll leave you this because of time. We'll leave you these recommendations. You'll have the slides. I just wanted to let you know that if you're not looking at these stats or standard errors or R squares, just a little trick. When you're looking at an unlevered or also called asset beta, if it's less than or 0.1 or less than 0.1, chances are it's not statistically different from zero. So just be careful with that. And now we're going to jump into the case study.
Okay, I'll give the quick overview of our case study. We're valuing Kroll's clothing store as of December 31st, 2022. Our subject company sells branded apparel in approximately 1,000 stores in the US and generates approximately $5 billion a year in sales. So what steps do we need to follow to estimate a beta? First, we need to answer a few high-level questions on how we'll estimate a beta. The currency of our analysis will be in USD, and we know our subject company is located in the US. We are going to use a 5-year look-back period using monthly returns, and we'll regress our comps using the MSCI USA index. As Carla mentioned earlier, well-diversified indices are highly correlated, and the choice of an index will only have a small effect on the beta. As the S&P 500 and MSCI USA are 99.9% correlated, there's an immaterial difference for choosing one over the other. We'll see in the demo that the new module requires the same high-level questions to estimate a beta. Okay, so next we need to select some comparable companies. We begin looking at companies that operate in the same industry. So our first screen will be to look for companies that operate in retail apparel. Next, we can look at other measures to screen for, including industry-specific and sales by geography and business. And finally, we can screen for companies using financial statement metrics such as total assets or EBITDA. Again, the company level beta module provides a company lookup tool where you can screen and filter results using the various metrics we just discussed, including by company name, industry description or industry GICS code, various financial statement metrics, and where a company is headquartered or incorporated. And CapIQ also has a powerful screening tool with even more metrics to utilize. In our first screen, we pulled a list of companies that operate in retail apparel, which includes Urban Outfitters. We can now look at some other measures to see if this company is a good fit. Let's start with industry specific. We see Urban Outfitters operates around 700 stores, similar to our subject company. Then we can look at where Urban Outfitter operates. Again, we can see the majority of their sales are in the US, similar to our subject company. And finally, we can look at the internal business units where Urban Outfitter generates revenue. And we can see the majority of their revenue, again, is in retail apparel, similar to our subject company. We ran the same screening process and generated a list of 9 companies. Now we can pull in some of those financial statement metrics and compare size measures to our subject company, which, as a reminder, has $5 billion a year in sales. Right off the bat, we can see 2 comps are significantly larger, and we made the choice to exclude them from our final comp list. Okay, I'm going to pass it back to Carla to start reviewing beta results.
All right, so what does it mean when we're looking at an historical levered beta, right? And we have those statistics that Aaron was describing earlier in the process. So let's look at the second column that talks about standard error. What does this mean? Let's look at the Children's Place, which is like highlighted in red as having the highest beta and the highest standard error of the estimate. What this means is that the true beta for the Children's Place is somewhere between, if you add 1.92 plus 0.44, which is your standard error, or subtract it, you get a range of 236 to 280. So there's a 68% chance probability that you have that much of a wide range. And if you want to get it to a 95% probability, you actually have to do 2 times that standard error. So it will be more like between 1.04 and 2.8. I'm sorry, like I got the math wrong. 1.104 and 2.8. So the point is that it's a very wide range, and so sometimes you need a way of letting you know whether this is statistically significant nonetheless. And that's what these t-stats tell us. And remember the 2 as the shortcut. Well, all of these seem to be statistically significant, even though the R-squares vary somewhere between 20% and 40%. They're all statistically significant. Let me I don't understand why the product mix is here. Now let's look at the 4 beta types that we have available here. It's the OLS beta, the Sun beta, Bloom adjusted, and the fuzzy check adjusted. And what we can see is that, Children's Place, again, seems to be the highest for the most part in all of these. The Sun beta is really high, and for most of these companies. And they're large enough that we're going to make the decision that they probably don't reflect it on a monthly basis, the underlying risk as well as the OLS betas. And so how do you see that? We can see the beta stability over time. These are like regressing Urban Outfitters as an example. And you can see over the last 10 years, like around like 2018, the sum beta, which is the dark blue, actually got close to zero. And the green line, which is the historical betas, never got that low. Now, the underlying risk of retail stocks really changed dramatically after COVID. So you can see the spike in 2020 because naturally, like with all the shutdowns, retail stocks, all of these stores were closed for a while. People were not going to, even when it reopened, they weren't going to stores. They were buying online, not necessarily buying as much as they used to. So we're now dealing with a higher risk profile after COVID. And the same is true of the gap. You can see the same thing. So in these cases, I would go ahead and just use OLS beta and not sum beta for these particular companies. So how do they compare then? If you look at CapIQ, a 5-year beta, and then use custom betas using the same index. So all of at the index level, you can see we use MSCI USA. The standard for off-the-shelf CapIQ is S&P 500. That's okay. But you can vary that, and we use total returns. So returns on a stock, which is what the theory would tell you. It includes the returns on a stock, includes both dividends and price appreciation, not just price appreciation. And the number of returns being 60 versus 59. And you do have differences in some of these betas as a result of the choices. So not telling you what to do, of course, but just letting you know that your choices make a difference in the resulting betas. So, okay, let's unlever these betas then. And the next step is looking at, do I look at debt over total capital, including operating leases? So for those of you who know that ASC 842 in the US, IFRS 13 elsewhere, that the new lease standards required operating leases to be capitalized on the balance sheet as another financing type liability. And so the difference is very different. And it does tell you, though, that the credit rating agencies take that into account. So as an example, look at the gap. The gap has a BB rating. And by the way, we're only looking at full ratings. We took out the notches, the pluses and minus. But the gap there, a BB is not typically associated with the 31% debt to total capital. The reason that they're only a BB, so below investment grade, is because they have 60% of debt if you include operating leases. So operating leases are actually a very material aspect. Of course, you want to make sure that you're consistent with how your DCF, your income approach, is put together, right? So your WACC should include operating leases if you separated rent expense between depreciation and interest expense, and you remove the interest expense. Otherwise, you don't. But just know that operating leases can have a big impact in this decision. So in this case, if we were looking at a market participant credit rating as opposed to a subject company, depending on your valuation purposes, then this would be more like a BB type industry. So does it make a difference? Well, look at unlevering with Hamada, what the gap unlevered beta is, including operating leases, is 0.87. If you exclude, it's 1.39. Now, if we include operating leases, which right now that's what we have in the Navigator, but we're going to, as Kevin said, going to give the option to the user to switch back and forth. If you included this would be the results of unlevering with Hamada. The median is, it ranges 0.93 if it's just plain historical, 0.97 if it's the last column, the VASI check. If you use Bloom, which brings everybody to 1, the unlevered beta was actually 0.84. So we give you the Harris-Pringle beta unlevering formula, so you can look at it afterwards. But what it does is requires a debt beta to do the calculation of unlevering. So before we did an Hamada, let's see what it looks like unlevering using Harris-Pringle. If you use Harris-Pringle, the betas are a little higher, the unlevered betas. And the reason is because it's saying, well, there is some risk associated with the debt. And so the risk also gets reflected in this calculation. If we go to the next one, so GAAP here, just to show you back to back, using OLS and Vasicek adjusted using both formulas. So Harris-Pringle, as you see, they're generally higher, the betas. There's like more risk, underlying risk, because you don't have all the credit for interest deductibility, and there is some risk to the shareholders of this much amount of debt. Using this debt to total capital for GAAP, this is like 60%. This is including operating leases. If you were to exclude it, these would look different. We're coming to the last polling question here, and this is, in estimating a WACC, do you typically include operating leases as part of total debt? First answer is yes, if applicable. B, not usually. C, not sure when to include or exclude operating lease liabilities. And D, as in David, other or not applicable. Just give it a little bit of time. So this is the last polling question, and we're almost done with the presentation. And then for those of you who want to stay, we can just do like a 5 minutes of a demo. Seems like someone is not showing the polling question on the screen. I don't know, on 24, I'm seeing it on the screen as live. Not sure technology. There's a lot of people saying they're not seeing the polling question.
Oh, it seems like they see it now.
Okay.
Sorry about that.
Okay, apologies about that. All right, it seems like we are getting most of our attendees to submit their responses. Apologies for that, to get your results. So I'm just going to give it like a couple more seconds given this issue. All right, so I'm going to push it, and we have a combination. Not usually is 45%, which is the majority, but we still have a combination of people incorporating operating leases in the WACC. So let's conclude on the case study. This is just, you can look at a range. So first quartile, third quartile, median, average of where betas are. This one is using Harris-Pringle. If you want to relever, assuming a debt to total capital, I know there was a question of whether we use the industry or we use the subject company. It really depends on your valuation. So if you're doing a financial reporting fair value, then you want to use market participant assumptions. So you sort of want to look at the industry that you're in. If you're using some other types of engagements where you're looking at the company fundamentally as it is, it's a minority interest valuation, then you want to look at the capital structure that exists under the minority shareholder, that under the assumption that they cannot change it to the market participant capital structure. So that it really depends. And same thing, the tax rate. There was a question on tax rate. Do you use the effective tax rate or not? Effective tax rates are, you know, you're supposed to use the marginal tax rate. So what is the rate you can deduct interest expense at? And so typically you start with the statutory. But we do know that some companies have presence abroad, right? Not just in the U.S., but in other places. And so the effective tax rate might give you that blended global rate that you might be able to deduct interest expense at. Just be careful, like if there's like a negative rate or whatnot, you shouldn't use that for purposes of a WACC. So relevering with Harris-Pringle in this case would give you 1.4 if you pick the median fuzzy check. I mean, obviously you can pick a different one. And relevering with Hamada, you got 1.45. In the end, it wasn't the material difference, but it all depends on how your range and what you pick. You don't have to pick the median or the average. You might pick a range between first and third quartile, and that would change your relevered beta. So the key takeaways here is like you want to start with comparable companies that closely reflect your subject company's business risk. You want to use multiple methods to estimate your betas, and you want to be critical about the methods you are using to make sure that you understand the results you're obtaining. With this, I'm actually going to, for those of you who can stay for 5 minutes, I know we're past the time and I apologize for that. I'm going to ask Aaron to go ahead and do a demo.
Sounds good. Thanks, Carla. Let me go and share my screen. Make sure, are you guys able to see my screen?
Yep.
Okay. All right, so this is the Cost of Capital Navigator dashboard for those who aren't familiar with it. And the new module, the company level beta module, is available here by clicking this tile to launch the module. And so then we get into the main stage of the module here, and first we need to fill out the general inputs. So to align with the case study, I'll go ahead and use the same inputs. So we'll select our valuation date of December 31st, 2022. And then we're going to choose the currency of the WACC. We have kind of the three more commonly used ones anchored at the top, but there's 100 plus currencies to choose from here. And this is important because everything that's calculated in this module is going to be denominated in the currency of WACC that's chosen. So there's not going to be any issues with inconsistencies with your currency. And then we choose the subject company location. We have U.S. anchored at the top, but there's 180 plus countries to choose from here. And the subject company location is going to drive which market indices are available. So for the U.S., for example, we have MSCI USA, MSCI North America, and the All Country World Index. If I were to change this to, say, I don't know, Canada, for example, we would get, I guess, pretty much the same results, but we would get MSCI Canada. If we changed it to India, let's say, we'll get some different results. So then we can see we get Asia, Asia Pacific, MSCI India, for example. But go back and use the United States for this. Then we choose our return frequency. We have the options of choosing monthly or weekly. I'll go ahead and use monthly with a 5-year look-back period. So it's going to be 60 months of returns. And then I'll choose the MSCI USA for the market index. So after choosing that, the performance index chart populates, so I get to see the growth of a dollar invested in the market index at the beginning of the beta calculation period. And as I add comparable companies, this will populate with the companies as well, so we can kind of compare how companies are performing relative to the market index and relative to each other. And now I can pick some companies by clicking the green plus icon down here. And we get our comparable company modal here. And a lot of stuff you can do in here, a lot of things you can search by, like company name. We show the number of observations. So since this is a 5-year monthly beta, we're looking for 60 months of observations. And if, for example, 10x Genomics only has 39, and we highlight that in red to warn you that, hey, this isn't going to cover the whole beta calculation period. You can search by industry and keyword. And then you can also add additional columns. So if you wanted to see for example, the country of incorporation, or you wanted to filter out, certain companies based on sales. If you wanted to see companies, below a certain threshold, if your subject company is pretty small, or if you wanted to search for comps only located in India or Canada, you can do that with this. And then, since all of our companies were in the apparel retail industry, I'll go ahead and search for the industry there, and then click the magnifying glass here. And so we'll get all the companies, within that industry. So we can go ahead and choose a couple, like, I don't know, let's say American Eagle. I think Gap was one that we were looking at, or Buckle. Choose Buckle, and then I think Burlington was in there as well. So we'll go ahead and choose Burlington stores. And as I select these companies, they're included at the top here, so I can see what I've selected if I want to change my search criteria, et cetera. So once I find all the comps I want to add, I click Submit, and they get added to the UI below, and then we can see that they're populated in this performance index chart as well. And so now we have our different sections kind of going through the flow of calculating levered betas, unlevering them, and then relevering them. And so I can expand each section to see the results. So here I can see the 5 different beta types, all denominated in US dollar. And then I can just keep kind of going through. So I can see the beta statistics. So all of the statistical quality measures that we were talking about are included here, so you can assess whether or not your betas are statistically significant, whether or not they're meaningful. And then we get to the unlevering inputs. As mentioned, we use Hamada at the moment, but we will be adding Harris-Pringle later on. So all we need for this are capital structure information, which we calculate for you, and then the tax rates. So I'll just go ahead and select the effective tax rates for the countries of incorporation. Apologies, I'm zoomed in a little bit here, so to minimize the blur that we're seeing when we're sharing our screen. So that's why things look a little funky. But I was going to mention as well, if you have a tax rate, if you know the company's effective tax rate and you want to use that instead, you can always type that in, for example. And then now that we've filled out our unlevering inputs, we get to our unlevered betas using the Hamada method. And what we could do, for example, is expand levered beta section and see how companies, the effect of the financing decisions affects the betas. And so we can see, for example, American Eagle's levered beta is 1.41 versus 0.93 unlevered. And then ultimately we get to the relevered betas. And what we do here is we have you select a beta type that you'd like to see. So for example, the OLS beta. We select the target capital structure. We provide the average and the median of the comps selected, or you can type in your own value, for example. Let's go ahead and select the average, and then a tax rate. And you can type in your own, or you can select the tax rate for the country of incorporation or the subject company location that we saw at the top. And then we get a range of betas, so we can see levered, unlevered, and relevered, and then we get to see, the minimum, the first quartile, the average, median, et cetera. What's cool about this is you can sensitize anything, so we can see, this was the OLS beta, how does the sum beta compare, for example, or if we wanted to edit something up here and we wanted to say, okay, we used 5-year monthly, what would it look like if we changed it to 3-year weekly, for example? So I can change these inputs, save them up here, and then give it a second to recalculate everything. And then we can see, we can sensitize our results ultimately. And then what we can do with this, we'll give this just a second to calculate. Everything will be recalculated up here, so the performance index will change to the 3 years. And then now we have you can see the number of observations updated to the weekly 3-year. We can see everything recalculated based on our new inputs. And then the last thing I wanted to show is we can export all of our results to Excel. So that's it for the demo. I'll pass it back to Carla for any closing remarks.
Thanks, Aaron, and thank you for those of you who were able to stay with us. I know we said that this was a 1 hour session, and it turns out that it was 15 minutes more. So we're very thankful for those of you who stayed. There were a number of questions that we were not able to answer during the webinar, so we'll get back to you individually. And if you have follow-on questions, feel free to email us, and we will. Actually, I'm not sure if I can push this live. Feel free to email us and to get those questions answered. Once again, thank you so much for joining us, and have a great day.